Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
We are back, everyone, with the 24th episode of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we're calling this one From Tina to Cream. That'll make a lot more sense to everyone when we get into it. Similar to my rant last week, Sonu, do you mind if I go on another little rant for a minute? People seem to like my rants.
Go ahead.
So we bought invisible fence at this new house in November. Sonu, what is today's date?
It's
March 7th.
March 7th.
I didn't want to trick you. I didn't know either. It still doesn't work. Okay, we've had them out repeatedly. We got the new box for this. It's all, wireless, and it's on your phone. And long story short, they were just out again this morning. They're doing more stuff. They're putting new antennas on. It still, as of now, doesn't work. And now I got to go to my cable provider, the internet provider, about splicing my 2G and my 5G, and my head's just exploding. It's really neat when it works.
You're just going to get a nice white picket fence instead?
I'll tell you, maybe get a better dog that stays in his yard. Maybe the easier way to do this. But apparently I'm getting closer. But have you ever had, you didn't know I was going to ask you this, have you ever had an episode like that where you paid a lot of money for something and 4 or 5 months later it still isn't working and you're just going in circles? Anything stand out to you like that?
I feel like my house. Like there's always something to do around my house. I bought my house. I literally have workmen coming into my house this morning. We talked about that. It's like I left the door open now. I'm in Chicago and here I've left the door open for people to walk into my house.
That's perfectly normal, right? And that's what I see all the time on TV.
Totally.
That's perfect. Yeah. All right. Well, let's get into it because you do have some people going to walk. Who knows? Maybe someone will just randomly come on the podcast and talk about the work they're doing at your house. But let's get into it. So again, we're going to talk about From Tina to Cream. You've done some amazing work on this, guys. What we've heard a lot about is listen. Bonds are now yielding like 5% for a time there. All you wanted to own was stocks because bonds gave you nothing. Now, does it make sense to own some bonds? It does, but we're going to still give our opinion why we like stocks. So we've done a lot of great work there. Mr. Powell goes to Washington, the semi-annual, what's it called?
Monetary policy update or update on monetary policy to Capitol Hill. Powell's in Washington, but he's going to Washington, going to Capitol Hill, basically.
Exactly. So this will be,
it feels Congress and Senate an update.
Yeah, the Congress and Senate get to grill them for a little bit on everything. That'll be fun TV watching. But we're going to give our take on that. And then some recent economic data, which, surprise, surprise, been a little strong. We'll talk about that. Then we're just going to round things up with some interesting things we've seen on the equity front. Fortunately, a lot of them have been fairly positive. We'll kind of wrap things up when we get there. But Sonu, again, I'll set the ball on the tee and let you hit it because you've done amazing work. One of the top questions we've heard a lot about is ERP. Let's just start, Sonu, you describing to the listeners what exactly is ERP, because it's this lingo that everyone apparently knows now. What does it mean? And should we be looking to add more bond exposure? Because, hey, we are finally getting some yield in bonds. I mean, again, this is a top question we've heard from our advisors, our Carson Group advisors, their clients, and it's been all over TV as well. Take it away for a few minutes, Sonu. First off, what's ERP?
It sounds like something from the medical industry, right? ERP and or
it's true.
Business consulting or something. I mean, they have all these acronyms. But equity risk premium. I mean, basically, why do we invest in stocks over the long run, right? That's because there is a risk premium. There's a premium you get for investing in risky assets, right? Which stocks are risky assets. But over the long run, you've shown the data. You've had some really amazing charts out there. Over 20, 30 years, it's, stocks are the place you want to be in, right?
Right.
But it's volatile and it's risky. Things can go down at 50, 55%, like in 2008. It can go down 30% in 2 or 3 weeks, like it did in March 2020. So there's a premium. And when I talk premium with respect to, let's call it risk-free assets, right? And what are risk-free assets? Treasuries, right? This is assuming the U.S. government borrows money, they issue bonds, safest asset in the world. They pay out whatever interest. The premium over that is called the risk premium. In terms of equity, for equities, it's the equity risk premium. That's ERP. Now, where trouble hits the road, where trouble comes is how do you measure it, right? That's the difficulty here, Ryan.
Yeah, so I'll jump in here for a second. So again, because I believe it was Jason Chenerit over at Strategas. He coined the phrase TINA. There is no alternative. Oh, see, there is no alternative.
There is no alternative.
Meaning, so what he meant by that, I believed it, and a lot of us did. Listen, bonds were this time, 15 months ago, were giving you like 0% yield or right around there. Not much, right?
Right.
So stocks were like the only show in town, a place you want to go because stocks are doing well and you could get something. Well,
for the last decade.
For the longest time. And now it's like people complain. It's just kind of funny. People just like to complain. They complain for the longest time. There's no yield. Now we got yield on stocks. Or on bonds. I'm sorry, but now you got to, how you're going to pay for it? With a little bit more inflation, right? That's just kind of how some of this stuff works sometimes. But now we actually have, you can make something from bonds. I mean, gee whiz, 6-month money markets are close to, 5% or something, or 4.5%. Yeah. So you can get some other places. And you came up with, along with Joey Guidry, who helps us so much on this podcast, the idea of cream, which apparently I had no idea. Go figure. It's a Wu-Tang song. Stands for what does cream stand for? Yeah, what does cream stand for? I loved it. Joey was awesome with this. What's that one?
Cash rules everything around me.
There you go. So we went from TINA to cream. So let's talk a little bit more about that. What exactly does that transition from TINA to cream mean to you, Sonu?
I mean, TINA, you said it, right? Look, over the last decade, after the great financial crisis, 2008, 2009, the Fed dropped interest rate to 0. So if you put cash in the bank, you get 0, right? Yep. Well, you get probably close to 0 right now as well if you're at JP Morgan Chase. No offense to JP Morgan Chase. I mean, that's where I bank. But, there are other places like money markets and things, and even U.S. Treasury bills which pay you 4.5%, 5%, right? So then the question is, wait, I'm getting 4.5%, 5%. That's fantastic. By the way, that's the other side of the Fed raising rates, right? As you mentioned, because inflation's high, the Fed had to raise rates, and now you get more, cash from, your interest-bearing accounts.
Let me just chime in just for a second. It benefits savers. For the longest time, savers were punished. Yeah. Now, if you're a saver, you actually get some yield to just kind of hang out and sit there. And that's the big question. So should someone just hang out and sit there at 4.5%?
That's $1 million question. I think it's fairly simple, right? So coming back to that equity risk premium, how do you calculate it, right? One way of measuring it for every $100 I put into a stock, how much do I get back, right? And it depends on, how much are they earning, right? We call it, and some of those earnings come to you back as dividends. Some of the, we talk about buybacks. They do buybacks. That's a way to return cash to shareholders, and some of it is reinvested, which over time comes back to you, right? So in that case, if I put $100 into a stock and, they return $5 in earnings, so the earnings yield, right? That's 5%, right? Straightforward. Now, it turns out that if you take the inverse of that, earnings yield, right? Earnings over price, right? I get $5 in earnings. I paid $100 for it. 5 over 100, that's 5%, right? Now, if you invert it, it's 20. Right. And that is your famed PE ratio. Right. I know everyone, who's sort of aware of equities and things like that are aware of the PE ratio. Right. That's a way of measuring how cheap or expensive a stock is. And I've always thought it's a little more intuitive if you actually use E over P. Look, if a stock is paying 5% versus another stock that's paying 1%, okay, the 5% is more value. Right? Like if I'm getting $5 instead of $1 and I, pay $100 for something. But then when you invert it, the PE ratios are very different, right? A stock with higher earnings has a lower PE ratio. A stock with lower earnings has a higher PE ratio, right? So then you get into growth and value stocks, right? That's, your easy definition of growth and value stock. So if you take a E over P and say, okay, that's your earnings yield. And then what everyone's doing right now is comparing that to bond yields, 4.5%, right? So the PE ratio for the S&P 500 is somewhere around 20 or something. Let's call it about 20, right? It could be slightly higher, slightly lower, depending on what markets are doing. Let's say it's about 20, right? So then if you take 1 over 20, that's 5%, right? Now, 5% is great when in a TINA environment, right? When you had rates at 0. Now, Treasury bills are paying 4.5%, 5%. Like, wait a minute, I'm getting an earnings yield of 5% in the S&P 500. Obviously, why would I do that? Why would I take risk when I can get the same thing in a T-bill, in a treasury bill, right? Which is why Goldman Sachs came out with the phrase, investors prefer the T-bill and chill, right?
Yep.
And we'll talk about Goldman Sachs later as well. But, it gets to, one thing being missed here is that, look, stocks are real assets. We talk about inflation and inflation protection, especially over the long term, right? Corporate earnings rise with inflation. I've looked back in history, Jeremy Schwartz and those guys at Wisdom Tree, shout out to Jeremy. They've done some great work on this. They've showed that dividends and earnings rise faster than inflation over time. Why? Because corporations can pass on their costs. That's what, that's why we pay more, right?
I mean, look at your burrito. Your burrito at Chipotle. I'm a fan of them too. It costs a lot more than it did a year or two ago. And did it stop you because your burrito costs $1 more? I don't think so. That's a good example.
Absolutely. Yeah. So all that to say, stocks are real assets, right? That's why we like stocks over the long run, because they're inflation protection over the long run. Now, in the short run, like what happened last year, inflation goes up, stocks are down. Then you like things like commodities and stuff like that as an inflation hedge, right? Like, I have some oil in my portfolio, I have gold, whatever it is, right? But over the long run, stocks work, right? And because they're real assets. And that's why you need to compare that E over P, that equity risk premium. The yield over there is not actually nominal yields. It should be real yields, right?
Exactly.
Real yields. And those are yields on Treasury. The easiest way to do that is go look at the yield on Treasury inflation protected securities, right? Again, government bond yields. Those are sitting right now over the next 10 years. 10-year TIPS yield is about 1.5, 1.6%. Then you look at the premium, like, there's still about 3.5% premium. It's not as much as it was when we had negative real yields, which was the case about 2 years back. But there's still a premium, right? And I think that gets to the fact that stocks are real assets as a premium. And then if you look at value stocks, right, stocks that tend to have more earnings yield, there's a greater premium there. And that's why, Brian, I think we've talked about this before. We've written about this. Yep. We prefer value stocks, things like financials, energy, some industrials, things like that, as opposed to growth stocks, which tend to be like your high valued stocks, things like tech or, communication services or, things like Amazon, for example, consumer discretionary stocks.
As we speak, I mean, industrials are only a couple percent from all-time high. I know materials had a rough day on Monday, but they're only a chip shot away from all-time high. So we're seeing some of that. I mean, this is a little bit more of a confusing subject. We're aware. I think Sonu, you did a great job to try to make it as easy to understand. But guys, this is stuff that we're hearing about every single day. I mean, just last week or a week and a half ago, let me make sure I read it correctly. It was Mike Wilson. He said that we're in the death zone, right? Talking about, again, when you go on a mountain, there's a certain period where you can't breathe air as well, and it's known as a death zone. ERP, according to him, we're in the death zone with this. But Sonu, what you're saying, there's different ways to look at this. There's different groups that potentially can do well. And death zone gets the attention, absolutely calling it that. But maybe it isn't so clear. Is that kind of, let's put a bow on this. Is that kind of what you're trying to point out here?
Absolutely. It's not clear. And I think a big takeaway is two things. Takeaways I'll give. One is stocks are real assets, right? When you look at the equity risk premium relative to real yields, there's still quite a bit of premium there. And that's just for the broad index, which are tilted towards growth stocks, right? If you look at value stocks, there's even more of a premium, which is why we like value. The other thing is, don't use this to time stocks versus bonds, right? There are other ways to do that, but looking at the equity risk premium relative to nominal yields is not the way to do it. And can I give a couple of numbers, Ryan, real quick?
What if I said no? Oh, geez. No, of course, absolutely.
No, when you look at the last time, the equity risk premium, especially compared to nominal yields, right? Which is what everyone seems to be doing. Last time it was this low was June of 2007. Remember what happened after that, right? The equity risk premium was about 1.6% at that time. It's like, good time to get out of stocks, right? Because you had a big 55% crash after that. Well, over the next 10 years, bonds had an average annualized return of 4.5%. The S&P returned about 7%.
Right.
And that's with a 50% pullback in 2008.
That might have been one of the worst times to ever go into equities, by the way, June of 2007, at least for the near term, But what you're pointing out, over a decade or so, stocks still did pretty well. I mean,
and much better than bonds. Over the next 15 years, bonds averaged about just over 3% versus 8.5% for the S&P 500. And that 15 years included even the COVID crash.
Right.
Right. It gets to one of those charts you put up on Twitter recently showing that, stocks do well if you hang in there for the long term.
Mm-hmm. No, absolutely. So great discussion there. And you did just do a blog on this, I believe, on Friday. You can go to carsongroup.com. You can find that blog if you want to dig in a little bit more. But this has clearly been something we've heard a lot about. We are aware it's a little on the geekier side, but we wanted to dive in. And the bottom line, it's not necessarily the death zone. There are some other ways to look at it. And like I said, I love the way you put it. Maybe this is just a time to continue to be a little overweight value, which we've been very vocal that we still like value over growth here, and that's a great way to look at it. A little shout out here, Sonu. I told my son I would do this. My son Sebastian's in the 6th grade. He was on a basketball team, a higher level, like an AAU basketball team. The very first game back in December, I think he had like 4 turnovers, 3 travels, no points. It was a shell shock. He'd always been like one of the better players. And then he's playing some better competition. So his first game was not very good. We'll just leave it at that. By the end of the year, though, he was definitely one of the better players, scoring a lot, playing great. And they actually won their championship on Sunday night. And he had a pretty good game. He had a really good assist on the last possession. So I told Sebastian I'd give him a little shout out on the podcast.
Congratulations, Sebastian.
Yeah, the Forest Hills Titans. Yeah, the Forest Hills Titans had a good season, and he did really well. So, all right, so next thing we wanted to talk about, Mr. Powell goes to Washington. The semi-annual grilling, if you will, of Mr. Powell. Let's be honest, we are recording this right before, or maybe the second it came out. Either way, neither of us had much of a chance to look at it. What do you anticipate here from Mr. Powell as he goes to Washington, and maybe how tough Washington's going to be on him? The other thing, he gets grilled pretty good in these things.
I think it's a chance for politicians on both sides to get on a bit of a soapbox, and it says more about them than it does about. I mean, I feel like we learn more about them than we do about what monetary policy is doing. We know what Powell's going to say. Powell's going to say, we want to get inflation under control. We know it's hurting your constituents, and we are going to keep policy tight, right, until inflation comes back to our target. That's more or less what he's going to say.
So that's called data dependent. We hear data dependent. I mean, and I think I know what that means, but like we hear it all day, every day. It's like one of those things you just, you hear it all the time. So you almost just take it for granted. To you, when we hear we're going to be data dependent, the Fed says we're going to be data dependent. Sonu, what does that really mean to a listener out there?
Well, I'm going to put it this way, that there's, when you say data dependence, you're kind of hanging your hat on every single piece of data that comes out, right? But that's
that sounds
data,
familiar.
CPI.
That's what we've been doing for 3 months now, I think. Yeah, the end of the world's coming. CPI was hot. Oh my goodness.
Data dependence sounds good, right? And great, and it makes total sense. Of course, you would want to look at the data. Why wouldn't you want to look at the data? But then, payrolls come out. Payrolls are hot. Market freaks out, right? CPI comes out. CPI is hot, right? Market freaks out even more. PPI comes out, even more reason. Now, if we get a soft payroll report this Friday, soft employment report, couple of soft CPI reports, and then suddenly things may swing the other way, right? So we just, with every data point, the market feels like, oh, the Fed's going to do X. Something else happens, the Fed's going to do Y. So we keep swinging around because you and I know the data is the data. It's the way it can be idiosyncratic based on how it's measured. We know all the issues with respect to how CPI is measured, rents, things like that. And we have to take, you have to pull back a little bit and say, okay, yes, we want to obviously look at the data, but we want to have a bigger picture. We want to have a bigger story of what's happening. And I think that's where when they say data dependence, and then the market is like literally hanging on every single data point and moving around, that's the other side and not so good side about data dependence.
Absolutely. And, we did talk about this last week with that hot, 517,000 job print in January, retail sales strong, lots of other things strong. You pointed out that's why we kind of like to look at, 3-month averages, 6-month averages, because we do anticipate some of the data coming out the next couple of months maybe won't be quite as strong because we had, some seasonal adjustments. We had really nice weather. I joked I went out and bought a car because the weather was good, like everybody else did over the last couple of weeks, and it's true. Can't get my invisible fence to work, but nonetheless, I went out and bought a car. Anyway, so Sonu, let's talk. Go ahead.
Did you get 2 keys for your car?
Yeah, I did. I got 2 keys. Yeah, they gave me yeah.
So it turns out I was talking to somebody at who runs a car dealership, and it's a Toyota dealership, and for a lot of cars, apparently Toyota, they're giving only 1 key. Why? Because they don't have enough chips to go into the second one. They're using those chips for something else.
Was that new cars though? Because I got a used car that had 2.
That was new cars. Yes, so that's why maybe these are new cars. So the whole chip shortage thing, which is interesting because I saw you posted a chart from the New York Fed, I think, yesterday, saying
I was going to say, we're like, Sonu, this is officially the moment that I'm going to admit something. We're turning into an old married couple because I was going to talk about this next, and you actually just put it up on a platter for me. It's funny how that happened.
There you go.
The New York Fed let me make sure I read it correctly. And there's nothing wrong with old married couples, by the way. I want to be very clear. That's good. We've done 24 of these. We're catching on how this works. The New York Fed Supply Chain Pressure Index came out. Let me make sure I read this correctly. It let's see here. It was the second largest monthly drop ever, and the main reason they said was because European delivery the delivery times were massively better. This is again a global look at the overall supply chain issues. According to New York Fed, supply chains are back to normal. If you look at that big surge higher, now things are back to normal. I think some of the question I want to ask you along the lines of chips and different things, we talked about this last couple of weeks. To me, it's maybe one more sign that China means it this time, right? This isn't Lucy with the football taken away from Charlie Brown. China is truly opening up. Things are getting better. And I get it. I mean, somebody pointed out on Twitter, you still can't buy like football helmets. So by no means am I saying everything is back to normal. Sure. But what we are saying is we are seeing signs that these supply chains are really coming back. And of course that matters for inflation. We had a major headwind with supply chains this time 12 months ago, major headwind with inflation. Now it's more of a tailwind. Do you think this is just another tidbit that the Chinese reopening with the better European data is confirming? What do you think?
I think so. It's very positive, right? And look, when these things, when you look at an indicator like this, and then, exactly as you said, somebody's like, you have someone on Twitter or someone say, oh, I can't buy a football helmet. Well, duh. I mean, just because it improved this month doesn't mean everything gets, better at the end for the end consumer immediately, right? It's going to take some time. It's going to take a few months. China opens up, then Philippines and, Vietnam, all of them start to produce more chips or whatnot, and then everything flows through better, and then hopefully that gets to, places in Mexico and the U.S. and Canada where they're making the cars, right? You
did some groundwork in Mexico and a little President's Day vacation. Did you notice any issues with the supply chain? Did they have all the bacon you wanted, and they have everything you wanted? It worked all right, right?
They had all the drinks with umbrellas that we needed, so that's all
the endless umbrellas is what we're saying. There were no shortage of those little. I remember being a kid going to the resorts. Oh, the umbrella was just the coolest thing in the world.
That's great.
Knowing my dad like I do now, he was probably giving me the umbrella and said, "Go ahead and lick it," But anyway, no, my dad was funny like that. Anyway, all right. So, hey, Orvie. Anyway, so with that, let's I want to ask a question. So here we go. So the Fed, they hiked rates, 50 basis points back on February 1st. Another rate hike, I believe, is March 22nd, guys.
22nd, yes.
22nd, 23rd, around then. My question, Sonu, to you. The Fed hiked 75 basis points, 75 basis points, 75 basis points, 75 basis points. Then they did 50 for a couple times. I think it's like 6 in a row now of either 50 or 75. And then they did a 25 hike. I just find it hard to believe, and maybe it's just me always being the natural skeptic, that they're just going to go back to 50. I think they said, you know what, we're going to stick with 25 for nothing else in the appearance that we don't want to come off like we're wrong. I just find it hard to believe they're going to jump to 50. I think the ballpark is 25% chance of a 50-point hike if you look at Fed Fund futures. Maybe we'll get some clue from Jerome Powell here the next day or so as Washington grills him. Do you really think we're going to see 50, though, sometime in March or later in a couple weeks, I should say?
I doubt it. And this gets back to the whole data dependency thing, right? Yeah. I don't think they want to see themselves as flitting around from one data point to another data point, right? And we got a bit of that last June when we got the article from the Wall Street Journal reporter saying the Fed is going to raise interest rates by 75 basis points.
Full disclosure, last June I had no job, so I didn't do anything the entire month of June. So I don't remember what happened. So don't blame me on what happened last June. I was in between jobs, I should say. Yeah,
we're glad to have you here. So
I'm glad to be here. Don't doubt that.
But so they went to 75 basis points, and that was sort of going against their own forward guidance, and that surprised markets, right? And surprised markets in a negative way, I should say. I mean, for obvious reasons. Like, wait, 2 months ago you said expect 50 basis point cuts. Now you're going to 75. 50 basis point hikes. Sorry, not cuts. What am I thinking?
Right.
And they went to 75, right? And now they've decelerated 75 to 50 in December to 25 in January. I don't think they're going to do 50, but it gets to the uncertainty out there, right? I think it's about 20-25% probability based on Fed funds futures markets, investors trying to price out, the Fed moves in advance. And it's not, the base case is still 25 basis points. Markets are pricing that, right? But there is a tail risk of a 50 basis point hike, and it gets to the uncertainty around the stuff.
Yeah, and I believe a week from the day you and I are recording this, I think it's the 14th, we have another CPI print coming out. So we'll have more, data dependent. We'll have more data coming out. I know we're getting a little long in the tooth here. I want to just point out one more thing. ISM services last week came in, I think on Friday, late in the week. 55.1, better than expected. Here's what I thought was really impressive and worth pointing out. It's things we're talking about here with inflation and supply chains. The prices index dropped 2.2, down 9 out of the last 10 months, the lowest number since January 21. Then you look at S&P PMI global services. That was stronger than expected, up over 50 expansionary for the first time since June. And here's the big one again. Cost pressures, second lowest since October 2020. Services make up a huge part of the economy. Services are growing. Manufacturing is not great, but manufacturing is coming back a little bit. We talked about that, I think, last week. But now we're seeing price pressures, time to delivery, the New York Fed supply chain. All this stuff's coming back. That's not bad, is it, Sonu?
No, absolutely. I think that was my takeaway from the PMI reports. And with US PMIs, you have a lot of other data too, right? Manufacturing PMI, yes, it's below 50, which means the manufacturing sector is contracting. But remember, this is just a survey. It's a survey of about 300 firms, something like that. You look at the data, the employment data, or even industrial production data, it's slightly, I would say, a better picture, right? Yeah. Manufacturing employment rose by about 45,000 over the last 3 months, right? Through January, we'll get new data on February. So things aren't falling off a cliff by any means. But to your point, my big takeaway was price pressures are going down. I think that's it. That trend is very positive to see.
Yeah, and to keep it simple, that was not a trend we saw this time 12 months ago, and we know how that all kind of shook out, and now it is coming back. So the final thing, we're going to take a little roundabout, take a look at equities and kind of the strength we've seen lately off some of the levels. But I will say, remember last week I mentioned I was having surgery? I did. On Friday, they took out 11 inches of my colon. I've had something called diverticulitis on and off for years, and it's not good. And I had to spend a few days in the hospital early January, but they took that out. I'm recovering nicely, as nice as you can. It hurts. Yes, literally sitting here. I'm in a little bit of pain, but I said, the show must go on. So, the show must go on.
It's going on. Question for you on that. Did you talk to your doctor about markets while this was happening?
I didn't. My doctor was a robot, so I have no idea. The robot. We had the Da Vinci robot. No, I talked to her briefly a little bit. She was great. Dr. Rafferty at Christ Hospital was really great, and along with the Da Vinci, it's just amazing. If I'd had this surgery 20 years ago, they would have cut me. We wouldn't be doing the podcast right now. They would have cut me open. I've got like 6 scars just across my belly, where there's little nicks almost, where the Da Vinci robot went in there, and Dr. Rafferty did the work, and it's just amazing. The healthcare and the way things are going. So again, not a recommendation of a stock, but I'll tell you, that Da Vinci robot, I did look at him. I said, "You're going to do a good job, right?" And he kind of nodded. He did not. But anyway, yeah, I'm on the recovery path. And I joked yesterday. I did a 5-minute interview with our friends at XM Satellite Radio, channel 134. I said I should be able to do that. I'm telling you, Sonu, I did the interview yesterday, and I took like a 3-hour nap afterward. I was exhausted. So after this is done, we'll just see. It is.
You go take a nap.
Exactly. I have a doctor's note to take a nap. So
there you go.
You can't beat that.
You can't beat
that. Anyway,
that.
so Yeah, final thing we want to talk about again. We had a bounce last week. I was under on Friday, and stocks had a big bounce. So go figure. Right off the 200-day moving average, a couple long-term trend lines. Our friends at Bespoke. Here's what I want to ask you though, Sonu, because this was a great study. We talked about this last week. Scott Brown did some work on this about when you're above the 200-day for a month long. No lows have ever happened before. Here's what Bespoke said. After 4 weeks above the 200-day moving average, after a 20% bear market. Our friends took a look there. They found 6 months later, S&P higher 11 out of 12 times, up 11% on average. A year later, higher 12 out of 12 times, up 20% average. Here's what really matters. This triggered on February 16th, just a couple weeks ago. Previous triggers, these dates might ring a bell with some people. September 82, July 88, May 2003, April or August. I can't read my own writing. It's August. So August of 2009 and July of 2020. Those were major bear markets. The market was recovering, and then you spent about a month above the 200-day. Sonu, this is lucky 13. If history doesn't repeat itself, but often rhymes, said Mark Twain. I'm pretty optimistic that the lows we're in and the upward trajectory is the way to go. And Bespoke just confirmed that with another study that we've laid out the last several weeks. What's your take on that?
I think everything just looks, I mean, you've been talking, last month we talked about, or was it January, when you talked about the bullish trifecta, right?
Yes.
Now you have for whatever, 6, 7, add 6, 7 more data points so that, I don't know, 6 factor, 7 factor. What do you say for that? But, it's all adding up. That's all let's say. It's all adding up, right? The positive signs. Whether you look at the surface, something like the 200-day moving average, things being above that. I love your line that you always say, bad things happen below the 200-day, right? We've been above it. We've stayed above it, right? And that's a good sign, right? But even underneath, we look at cyclicals, look at small caps, they've held in there. Look at industrials, materials, energy. These are not things that would be going up if the economy is falling off a cliff.
Yeah, we've seen a lot of steel stocks make new highs. We've seen casino stocks make new highs. We've seen some auto manufacturers make new highs. So that's not what you tend to see in front of a recession. Natural gas just yesterday on Monday dropped 14.5%, one of the largest drops ever. That was after it was down like over 60% the previous 6 months. Similar to what we're talking about. Doesn't matter the asset. I'm just saying when you're in a bearish trend, when you beat the 200-day, that's when bad things can happen. And we saw that clearly with natural gas. We're above the 200-day now. You mentioned, kind of cyclicals, financials, something that fascinated me. I love market sentiment. Goldman Sachs, not a recommendation. But again, there was at the end of January, Goldman Sachs is the title that economists come up with. Kind of clever. But the stock's doing fine. And then just over the weekend, Barron's had a less than bullish, I love Barron's, huge fan, read it every weekend. But Barron's had a less than glowing take on Goldman Sachs. Yet I look at one of these largest financial companies out there, relative strength hanging in there. It's looking okay. I mean, personally, if I'm an investor, I like to see negativity toward financials like we are. Again, that's a group that we are overweight. One of only 3 groups we're currently overweight. You want to talk about financials a little bit there, Sonu?
Now, we started the podcast talking about the equity risk premium and how certain pockets, how there's the equity risk premium in our views still exists, right, for stocks overall. But certain pockets of the market have a higher premium. What are those pockets? Well, you just mentioned it. Financials, energy, industrials, right? We like those. We are overweighting those sectors. And within financials, you have your big banks, whether it's investment banks or your regular Bank of America, Citigroups, JP Morgan Chases of the world. Right. And I think that's positive. They have, those are your quote unquote value stocks. I mean, in that they have a higher E over P ratio, just to come full circle, have a higher earnings yield, especially compared to real yields. People, please compare this stuff to real yields because stocks are real assets. I'll stop with that.
No, exactly. The final thing that I wanted to point out, I'm impressed by how quickly people became bearish, right? I mean, I joked middle of February, longtime bears were on CNBC talking about like bull markets. I'm like, what's going on here? It was bizarre world. Then we had a 5% correction, ballpark approximately. Just one way to look at this, but the AAII sentiment poll, we've talked about this before, looks at individual investors. Sonu, we had like 3 weeks ago, the highest number of bulls in 52 weeks. Then you have the correction. Just last week, we had more than 1.9 bears to bulls. I took a look. Never in history have we made new highs in bulls. And then within 3 weeks, a bunch of bears came out of the woodwork. This data goes back to the late 80s, okay? Never happened before. So sure, small sample size. And there's other examples of this that I'm seeing out there, but that little 5% correction, which is perfectly normal. We talked about the February hangover before. We had it, and now the seasonal bullish time frame of March and April that we talked about last week are here with some skepticism. I like seeing that. Sonu, final comment. The jobs number is this Friday. Do you want to take a guess what that number might be? And anything else you want to say as we sign off here?
Putting me on the spot there. I'm going to say 250,000.
Yes,
250,000. I'll put that. Okay. I think market expectations are for 200,000 maybe. So,
right.
What's interesting is if it comes around, let's say about 200,000. My prediction, 250. So keep that, right?
Okay.
If it comes in 200,000, everyone's going, oh my God, that's such a big slowdown. And of course it is, because January is 517,000. You've gone to 200. That's a massive slowdown in hiring, right?
Right.
But 200,000 is fantastic. Keep that in perspective.
Especially after making 4.8 million jobs the year before. Put it in perspective. Yes. So, yeah, great discussion there, Sonu. I'm going to go with 222,000. Totally random. Ooh, I just like a bunch of twos. We'll just see. Obviously, we'll break down the jobs number next month on the 25th. Next week will be the 25th episode of Carson's Facts versus Feelings. Yeah. But everyone, thank you so much for being here. As always, Sonu, thanks to you for a really fun discussion. Thanks to my doctors who did everything they could to make me be here this week. I was half worried you'd be flying solo, but I'm glad to have gotten through the podcast.
Glad to have you back, man.
Yep. I'm not officially back. I'm going to go take a nap the rest of today. I've done my job for today, but I'm teasing. I'll do a little more work.
That's all good.
Yeah. Everybody, thanks again. We'll be back next week with the 25th episode, but this was the 24th. We'll see everyone soon. Carson's Facts versus Feelings signing off. See you then. Bye-bye.